Hello and welcome to this discussion. We'll be talking about getting selective in single country emerging markets. I'm Jamie Gordon, features editor at ETF Stream. We're joined by a mixture of index providers and investors, so I'll let them introduce themselves. We'll start off with Sarab, if you wouldn't mind.
Thanks, Jamie. My name is Saurabh Katiyar. I'm heading the EMEA Index Solutions Research Team based out of London. I've been in MSCI for more than a decade, and my role is to engage with clients across client segments and explain to them our index offerings and build custom index solutions with them.
Edmund?
I'm Edmund Shing, Chief Investment Officer at BNP Paribas Wealth Management, based in Paris.
And Beckham.
Hello, I'm Paco Breton. I'm Head of Portfolio Management at Nutmeg. We are a digital wealth manager investing mostly for UK investors.
Great stuff. Sarab, coming to you first. Obviously, there's been a lot of conversation this year about concentration risk over in the US, but obviously there's also been the same kind of lingering conversations, shall we say, about concentration within emerging markets, particularly looking at China. So coming to you first, it'd be good to hear, is market concentration an issue in emerging markets, and how can getting more granular help to counteract this?
Sure. Yeah, thanks. That's a great question to start with, because when we are talking to our clients, market concentration is a key concern for them. And it's like very easy to see why, because a lot has been written about US, the rise in the market concentration there due to the Mag 7 rally. But if you look at other pockets of developed markets like Europe or Japan, we see similar levels of market concentration there as well. In fact, if we look at the top 10 stocks in either US, Europe, or Japan, we see that their return contribution to the overall market return has been close to 40 to 50%. So it's not just the level of high market concentration, but really the concentration in returns, which is an even bigger issue. Now, this is not just unique to developed markets, like you said, Jamie. This is a concern which is also true for emerging markets. In fact, when it comes to emerging markets, like you said, there are some large, securities. Countries like China, there are some large sectors, information technology, financials, which even which tend to dominate and in a way limit the diversification, increase the volatility associated with emerging market returns. Even in emerging markets, if you look at the top 10 constituents today, they are making up more than a quarter of the emerging market index, and it's a level which we have not seen in the last 20 years if we just ignore the pandemic rally, for example. Now, going back to your question, you said like how can we be more granular and how can we use that as a solution for this market cap concentration. So what we have seen our clients do is basically focusing more on some of these granular themes like country selection, stock, sector selection, or even like some specific themes like deglobalization, because that exposes them to a broader range of opportunities. For example, we've also observed our clients use capping strategies. So this could range from a simple issuer capping to a more sophisticated adaptive capping, or maybe an alternative weighting schema like equal weighting, just to limit exposure to some of these large names and enhance diversification.
Great stuff. Edmund, sort of similar question to you. Is what Sarah was saying sort of, I guess, mirroring what you'd say in terms of, I guess, is market concentration an issue in emerging markets? And how are your team sort of addressing that?
Well, I think it's always been an issue in emerging markets, to be honest with you. If you look at market cap to GDP ratios to see how much of a country's economy is represented in the listed stock market, the answer has always been much smaller than in developed markets. And of course, on top of that, you have the issue of free float. Do you use free float or not free float? And again, if you were to apply free float, then the free float market cap of an emerging market is typically really quite small compared to GDP. And very different to, let's say, what we would expect in the big developed markets like Japan, European, or of course the US markets. Now, if anything, that has got a little bit more extreme over time, because of course, if we look at the 4 big country weights in MSCI emerging markets, you're talking about China, India, Taiwan, and South Korea. The first debate is, of course, should we even include South Korea and Taiwan in emerging markets? Because if you look at it by a number of metrics, they look very much more developed than developing. So that's already one question. But let's say we just take the emerging markets index as is. Clearly, there's an issue of concentration, and this has actually become more acute with the rise of India. So actually, you really have 4 big blocks which account for, I think, over 70% of MSCI emerging markets, just looking at 4 countries, and of course 3 of them being quite interrelated, being China, South Korea, and India. So yes, we do think it's an issue. We do try to, but again, in the context of a diversified portfolio, stocks and bonds and global stocks and global bonds, remember that emerging markets isn't that big. The biggest problem in concentration today is, as has been mentioned, clearly the US stock market and the weight of the tech stocks and Magnificent Seven. That is the biggest concentration risk. I think next to that, emerging markets, it's quite small beer in comparison, in terms of the risk to an investor. Nevertheless, it is a risk because they're all Asian, and 3 of them are pretty interrelated. So if China has a problem, you're going to probably get problems in Taiwan and South Korea as well. And that's that's well over 56. That's getting up towards 50. Over 50% of MSCI emerging markets, which are highly correlated.
I forgot which one of the Mag 7 it is, but there was a statistic about over 40% of their revenue being derived from each other or something like that. So I guess in the same way that you see that within US large caps, it's a similar thing within emerging markets in a sense of that, as you were saying, that interconnectedness piece.
Absolutely, especially with China. China dominates in economic terms. And so, of course, South Korean exports and Taiwanese exports will be very interrelated. And of course, a lot of, Taiwanese stock market earnings come effectively from come from China, either directly or indirectly, because they have a lot of manufacturing operations. Foxconn, for instance, is very heavily implanted in China.
Yeah, no, great stuff. Pacom, similar question to you. How are you feeling about sort of potential concentration risk in emerging markets? Are you sort of more of the sort of Edmund Ching position where this is, it exists, but not as much of an issue with the same prevalence as when we look at the US? Or is it more that sort of view of the, that interconnectedness piece? Is that actually meaning you're getting still that level of high concentration just through a sort of different medium?
Yeah, I mean, as Saurabh and Edmund were saying, I mean, clearly the concentration, we've seen it across the globe, and actually the US is probably even more problems than emerging markets. So really, I would say probably nothing new under the sun here for emerging compared to the rest. However, there's still some specificity if you think about on the emerging market. The country part is one thing. We've seen enormous evolution of the weights of those emerging markets. We have now some, like, for example, Brazil, Mexico, or even South Africa, which are much, much smaller than what they were 10 or 15 years ago. So clearly the shift has been really a concentration on the 4 countries mentioned earlier. So China, Taiwan, South Korea, and India. And as well, what is interesting, for us, for example, when we tend to invest mostly as an index buyer, where we're not going to do single stock selection, but really buying blocks of countries, blocks of regions. And in emerging, it's even more, one of the main decision factor we face is whether we take a cap view or not. For example, if you go into EM Asia, if you take an uncapped view, for example, TSMC for the large Taiwanese chips manufacturer is going to have a very disproportionate allocation, and a couple of big as well Chinese stocks like Tencent or Alibaba will be in the same case. And actually, it's even more the case if you restrict yourself to a sort of, ESG framework or some, SRI type of allocation, where you're going to concentrate even a bit more your universe. And in this case, if you don't cap yourself, you might go from an allocation in one stock of 30%, and if it's capped, it becomes 5%. And so basically, it's a massive decision to take, which is going to be a very large dominating factor in your future performance, whether you take this concentration or not. So yes, it is really a question mark when you see some of those gigantic stocks in EM, like you've seen in the US. And what do you do? Where which type of approach you take if you're fine with the concentration, or you want to force the diversification by putting a cap on the maximum weight. So that's that makes it a bit tricky to navigate, and really can change your portfolio performance on a yearly basis.
Interesting stuff. Saurabh, coming back to you and sort of making the allocation case for emerging markets here, looking at it from a risk return perspective, could you talk to us a little bit about how emerging and developed markets compare?
Sure, yeah, that's something I can cover. Yeah, so if we again look back at the foundations of EM investing, I think the story always has been a strong GDP growth, improving macroeconomic fundamentals, and the macro story still remains strong. If we look back at the IMF forecast and some of the historical data, the EM countries, they are expected to continue to show stronger GDP growth rates, a narrow inflation gap with developed markets, stronger fiscal policies, trade surplus, etc. So all of that still paints like a good picture for emerging markets, and this should in theory translate to a strong performance for emerging markets. But if we look at the performance of emerging markets and the developed markets over the last 30 years, we see two contrasting halves. So
Mm.
if we start from 1995 to 2010, emerging markets outperformed significantly. But in the past 15 years, they have really struggled. And if you look at what happened, there are a few interesting nuances. First of all, the performance of MSCI World, which includes the developed markets, it was substantially held by strong outperformance of US. While
Mm.
on the other hand, China, which is the largest EM country, significantly underperformed. Some other factors which have also contributed to this underperformance was that EM countries, on the back of some of the GDP growth, and I think Edmund was making this point very nicely, where he was talking about the smaller free float and how the EM market cap may not be that large as proportion to the GDP. We see something similar, even though EM countries the economy continues to grow, the listed companies haven't grown as fast. Their earnings growth has been quite slow in the last decade as compared to the previous 15-20 years. And another factor which has really impacted their performance has been the currency weakness. This was something which didn't happen that much in the early 2000s, but especially in the last decade.
Yeah, great
One
stuff.
last, so, sorry, one last thing
Sorry.
which I wanted to mention was that we also see in terms of performance drivers. So we use a measure which we call cross-section volatility, and this is something which is in a way it's a proxy for stock selection opportunities, because it measures the dispersion of returns. And when we do that, and we use our risk models to analyze what are the performance drivers, we see that countries are the most dominant factors. Country exposures are the more dominant factors in emerging markets, while in developed markets, it's more industry groups and style factors like quality and value. Again, just highlighting the role of country selectivity, within emerging markets.
Pacom, coming back to you, it'd be good to hear a little bit about how you're viewing or comparing emerging and developed markets. How has the sort of use case for allocating to each changed for your team?
Yeah, I mean, to be honest, when you look back over the recent history, has been a very interesting journey. I mean, as Saurabh was saying, basically, we've seen lower earning growth in emergings than we've seen in some other part of the DM. I mean, especially the US, which been, the massive outperformer over the period. One thing I would say that I find really interesting is post 2008 world, or up to 2008 or 2010, the view was pretty simple, right? You would invest in emerging for the growth, you would get potentially more risk and more reward, and so more volatility, more long-term return, and you would buy it as well. Very different compared to the other developed markets. You would usually don't add the currency risk, because the currency basically would help you and would be part of the return. So that was the old view, the view 10 or 15 years ago, which was more or less the long-term one. And this has changed quite dramatically, because post 2010, you've seen that basically emerging markets haven't been really more volatile than the rest of the world. The performance has usually been lower, and actually their currencies hasn't really performed that well. And so you are now in a situation where some of the old typical mantra and view of why you would buy emerging markets not totally there anymore. So the question is it going to change overall? And do you as an investor, do you think basically you might go back to a trend, or basically what was true at some period, and potentially mostly because China joining the FOMC and all the some of the shift from the industry from the Western world to Asia basically has been done, and this is going to be difficult to come back. So clearly the old paradigm for emerging market has changed, and I think some of the attractiveness overall for emerging market is not totally there anymore for investors. in the short term. There is of course some amazing success stories, but the case for higher risk, higher returns, and performance from the currency has been clearly a bit challenged over the last few years, and it's not totally clear if it's going to come back easily.
Yeah, great stuff. Edmund, if we look sort of taking a view looking forward now rather than looking back, it'd be good to hear maybe about how differing interest rate policy pathways might influence, I guess, different performance outcomes for different emerging markets. Is this something your team's been looking at?
Yes, but I would actually take a step back and take it at the asset class level, because we talk about comparing emerging to developed. We haven't talked about bonds. Actually, it's quite interesting that if you look at emerging market bonds, particularly denominated in US dollars, so hard currency, you find over the last over 25 years, so since the late 90s, is that this asset class has actually outperformed emerging market equities if you take it in dollars or euros, and of course at lower volatility. And so actually, it's quite interesting what Paco has been saying. In a sense, we're taking a lot more risk, hoping for more return. But funnily enough, even within the emerging market segment, you could have taken less risk and had more return at lower volatility with the bond segment. So we've actually been focusing more on emerging market bonds, in particularly in US dollar terms, to take out the currency issue. And that's been a very successful performer, actually, and nicely outperformed developed market bonds. So yeah, we would say look at the bonds before you start looking at the equities, first of all. And that's certainly been something that's been rather successful. And they still, of course, deliver very nice yields for a basket of sovereign bonds that are basically mostly investment grade. Yes, there is a little bit of sub-investment grade in there, but it's mostly investment grade. And you get a very nice yield for that, to be rewarded for that. Now, if we turn to the equity side of things, we are still allocating to it, but we certainly have reduced, I think, our allocation, and we certainly look at certain economies more favorably than others. Now, of course, at the moment, India gathers all the attention on a single country basis because of the inexorable rise, the economic story. However, I always caution investors that this is all very well, but we could have said the same thing about China a while ago. And remember that the correlation between GDP growth on the one hand and stock market performance is exceedingly weak, if not zero. So you shouldn't read across from strong economic growth to, oh, therefore the stock market's going to do well. I mean, in India's case, it happens to have done well, but I think there's not necessarily interrelated. I think what is more important is the fact that India geopolitically is in a very interesting spot. Obviously, a very youthful population. Obviously, you're growing a very fast emerging middle class, as we have already seen in previous decades and years with China. But more importantly, geopolitically, somewhat interestingly positioned between, on the one hand, the Western countries, and on the other hand, countries such as Russia and even China. They're a sort of independent nation, and I think as a middle power, independent middle power, actually is a very interesting geopolitical position, which actually can be pretty advantageous to the economy and also to the companies operating in that economy. And remember, India has had a very deliberate policy of encouraging local enterprise, rather than allowing foreign enterprise to have free reign in the country. So this is another factor to keep in mind.
And obviously, as well, a burgeoning sort of investor base there as well within the country, investing within its own equity market. So, yeah, plenty of factors for support there. So, what's your view on the sort of interest rate policy pathway question? Sort of will that sort of policy divergence sort of lead to different outcomes for different markets?
Yeah, absolutely. Jamie, I think we have talked about, like Pakom talked about, currency weakness, and I have mentioned that as well. So I think, especially when it comes to EM countries, the interest rate policies, they always tend to, strike this balance between inflation control and currency stability, because those countries who are maybe, like facing inflation, currency challenges, they would experience more volatility in investment flows. So, for example, when some EM countries raise interest rates while others are keeping them low, the high rate countries would expect to attract more foreign investment due to better like fixed income returns or bond returns, etc. Now, this is one reason why some of these EM countries are generally more careful about cutting their interest rates. Two good examples are probably India and Brazil, because it's not that their inflation is running wild, but they are still being cautious with interest rate adjustments just because of concerns about currency depreciation and also the associated, let's say, impacts on economic stability and inflation. So by just keeping those higher rates or maintaining those higher rates, they are trying to support their currencies, they're trying to manage the inflationary pressure, as and while they still have to balance the need to encourage the economic growth.
Great stuff. Just because I know we've only got a few moments left, Pekoma, I'd like to come to you and ask, how might investors expect emerging market allocations to evolve over the coming decade? What are you keeping an eye out for?
I mean, a great question. I mean, it's of course the coming decades. It's a pretty tough one to see. I mean, things change relatively quickly. I mean, the flavor of the month is, of course, the U.S. positioning and whether the U.S. is going to try to repatriate more of the production factors inside the United States, which definitely will have some reverberation towards emerging markets as a whole, as well. The importance of China and whether we're seeing really some counterpower and counterbalance to the importance of China in the emerging market blocks, and whether we're going to see it more shifting towards India, towards other countries. So I think for us the view is more or less a relatively cautious one over the midterm. And as I was saying before, the case which was potentially strong at some point is now more plateauing in a way. Somehow doesn't mean that there are not some that are rising. Clearly, we see some markets which are less talked about, but like Vietnam or like some of the Southeast Asian countries that are becoming clearly stable with the young workforce and being able to substitute some of the production that was delegated to China. But I would say overall, it's a bit more a cautious view, taking emerging as a whole somehow. And let's not forget as well, in emerging there is always an instability factor that tends to be forgotten easily when things goes well. But we saw it with Russia and the war against Ukraine, that it can come back pretty quickly. And when it does, basically you can see all the US dollars funding drying very quickly. And in this case, if you have assets in those countries, it can be very very painful. So clearly, if you don't really get the reward easily, plus you get part of the risk, at least some of the tail risk there, clearly I think for now it weakens a little bit the case. Not even talking about the impact of the dollar on some of the interest rate, but yeah, we think the case is clearly a bit weaker than it was some time ago. And let's see if it comes back.
Edmund, do you agree with the points that Pekoma was making there, or are there other evolutions that your team are watching out for within emerging markets?
One of the major things that I'm watching out for is the emergence of the Middle East. And we talked about India, and as you mentioned, Jamie, one of the driving forces for India is, of course, the building of a domestic investor base supporting domestic equities. Now, what we're seeing is, firstly, rapid development economically of, for instance, the United Arab Emirates, particularly based around Dubai and Abu Dhabi, and also Saudi Arabia. They have very ambitious continuing economic development programs, and they're trying to encourage inward investment very aggressively, Dubai in particular, because they don't have oil, so they need to find their own sources of revenue. And part of that, of course, is the development of domestic stock markets, which have been very successful with lots of IPOs, not only in oil and gas, as you would have, of course, imagine, but also in other areas like banking and technology, increasingly technology. And given the attractiveness of these regions to entrepreneurs, I would expect to see more IPOs of various types of also consumer-facing businesses more and more, because again, consumption is fast on the rise in these segments. So I think the Middle East is an area which will become much more important in terms of emerging markets, emerging market equities over time, as you see more IPOs and you see the continued development and encouragement of the domestic investor base, backed by more effective and solid regulation and incentives from those local governments.
So is this roughly sort of chiming with what your team are looking at, or are there other developments at MSCI keeping an eye on?
Let me first start with a disclaimer that MSCI is not an advisor, so we're not allowed to make, let's say, forward-looking recommendations. But what we can do is we can look back at the history and see what our deep history has taught us. And one of the things which we see, or rather, some of the client trends also that we are hearing back from our clients, and geopolitics, I think, like Edmund was saying, clearly has traditionally influenced emerging market allocations. If you look at the environment around us today, again filled with geopolitical landmines, Israel Hamas war, the Russia Ukraine war, and these events, like we can imagine it, they create risk, but they also create opportunities, and this ultimately would contribute to some of these diverse views on what to do with emerging markets. But what we see is that geopolitical risk is becoming a central consideration in EM allocations. It's not just a sideshow. And when referred to rise of Middle East, we see, this trade corridor, again, contributed by geopolitics, developing between, the Middle East and the Asia trade corridor. So Saudi Arabia, for example, developing closer relationships with China, UAE developing closer relationships with India. So definitely, these would shape, the evolution of emerging markets. We see again, the role of geopolitics in the US and the China decoupling and the growing tensions. And again, this has impact on trade, technology, but definitely, investment returns. In terms of our client trends, we see them, splitting their EM allocations into EMX China and China. And finally, something which we have touched upon a lot, when we talked about emerging markets, we were always talking about single countries. So again, there is this greater understanding, I would say, that emerging markets, it's not just a homogeneous block, but a collection of countries with their own distinct growth trajectories, paths. And this has, I think, again, sparked a lot of interest in focused, country selection within emerging markets. And that would also have an impact on EM allocations going forward.
Fantastic. Seems like geopolitics are front and center. We could see new leadership, and there's an increasing need to break emerging markets down rather than viewing them as a single block. I think those are some great takeaways, and I'm afraid that's all we've got time for today. But thank you very much to our speakers and everyone watching from home. We'll see you soon. Take care.